Samit Vartak joins us, CIO and partner with the SageOne Investment Advisors. And he, in a sense, is not a large cap investor, but a mid cap maverick, believes in buying companies which could grow between 15 to 20% because he believes that for a market like India, that is where you should really be focusing in on. So nice to have you back. Thank you for joining us. Mid and small cap stocks are in headline for the wrong reasons. Everyone is feeling the pain of excesses which got created last year. What is your sense? Do you think we are nearing the end of the decline, or there is still some more froth in the system?
Hi, Nikunj. A pleasure to be here. See, I think mid-cap, small-cap is a pretty vast universe. So anything below 1 lakh crore is mid-cap, and anything below 30,000 crore is small caps. There are about probably 4,500 companies in the small cap basket. Right, and I think unfortunately what happened was in the last few years across the board, the smaller the stock, the higher has been the rise, and many investors have been investing without really digging deep into the companies, for the promoters, and looking at the business model, because the stocks used to move so fast that invest first and then research later kind of philosophy was pretty prevalent. And more importantly was the IPO kind of deals where it was all about the Excel kind of future of the companies, where companies, we used to also get multiple deals, almost 4 or 5 deals a week in the pre-IPO, and all the projections were like 4 or 5x in the next 3 to 4 years. And it's impossible, when thousands of companies are projecting such kind of a growth. So there is a lot of froth, in that market, in the smaller companies, where a lot of operators also got probably active, and then, a lot of the prices were active. But then again, if you're just looking for 15, 20 stocks, there are a lot of opportunities which are emerging, right? For me, it's all about what is your long-term returns goal. If you're targeting 20% plus returns goal, it's almost impossible to make that in the large caps, right? So the only way you can find 20% plus earnings growth companies is most often in the small and mid cap space, right? So here you can't take a basket approach, but it's all about specifically finding companies, betting on promoters, finding on companies who are the best in the industry, who are gaining market share. These are the companies in a really tough, bad market, I think, outshine more, because in a good market across the board, the entire, the tide raises all the boats, and it's very difficult to differentiate, which is the right boat to ride. And I think that's where, going forward, that's the important part. I don't think the entire universe has corrected enough. There is a lot of fraud still remaining in terms of valuations. But if you are a good stock picker, I think that's the market, going forward. If you look at last 3 or 4 years, every year almost, the percentage of companies beating the BSE 500 or equal weighted BSE 500 index beating the normal BSE 500, the weighted average index used to be way higher, above 50%, and that's that can't continue for long. After a long time, that percentage of companies has come down to as low as now 30%, right? So 70% of the companies are not beating the index, and in this market, then your universe, which you can which will outperform, will shrink significantly. So now important that you just don't bet on the entire sector or entire theme, but bet on promoters and stocks.
Samit, but historically I've seen that when you get classified, the market always tends to classify you in terms of market cap. So there is a time when large cap does well. There's a time when small cap does well. There's a time when mid caps, they do well. There are very few exceptions when these cycles are at play. So what you're flagging off for our viewers is great. They look for good companies, don't get attracted or trapped by this entire market cap, phenomenon, and don't generalize everything. But is it a cycle which we must regard? Because there are times when great businesses in mid and small cap stocks also, they tend to underperform when the cycle is against. Similarly, in large cap, there are great businesses that tend to outperform even when the cycle is at play.
No, that's completely true, because what happens is that after all, the mutual funds are also, aligned in the same way. Is that, your midcaps, small caps, mutual funds, and those are the market moving sort of entities, right? So you do get, it's a vicious cycle. When a particular mutual fund or any particular theme does well, there is a huge inflow into that kind of a fund, and the small and mid cap space is extremely illiquid, and hence, while you get the inflow, you yourself can run up the stocks, and then with running up the stocks you get outperformance, and when you get outperformance you get more inflow, right? And that cycle goes on, especially in the mid and small cap space, mainly because of liquidity, and then the valuations go up, and that's what has happened in the last few years. And I think going forward, it's possible that investors, if they start redeeming, then some of these themes, there will be forced selling, and then they will start underperforming, and with underperformance again, then investors try to get money out of that. So I mean, I believe this space, small mid caps, is a space where the size of funds has to be much lower. Otherwise you lose the flexibility of getting in and out. You're mainly forced holder of the stock because you can't get out, and when you're forced to get out when there is redemption, then you have no control, because who is going to buy? Whenever there is a downtrend, buyers just vanish into this, from the system, and you can do any kind of stress test, but in a falling market, there is absolutely zero liquidities. So that's the problem, and unfortunately, we have to go through those cycles. It's not just this is not the first time it's happening. It happened in 2008, 9. It happened again in 2011. It happened in 2015, 16. It happened in 2018, 19. I mean, 18, 19 was one of the most brutal cycle for the small and mid caps. Again, people had piled up into it from 2016, 17, up to that peak of the cycle. And then we saw what kind of underperformance they went through. But again, the indices underperform. But if you are a good stock picker, even during those times, your portfolio kept on going up. So it's all about stock picking in the small and mid caps. In the long run, if you look at last 15 years or last 20 years, the indices, small and mid cap indices, have not beaten the large cap indices, right? So one has to keep that in mind, that if you are betting on the entire universe, you are not going to beat the index, and at the same time you are going to have higher volatility, right? So high risk and the same returns, not worth taking the bet. But if you're a good stock picker, that's the only space where you can get that 20-25% kind of returns. And during an upcycle, when like the upcycle we had from 2020 to 2024, or from say 2009 to 2011, the small and mid caps significantly outperform. So for example, small and mid caps have a lot of cyclical stocks. So in 2020 to 2024 kind of a cycle, the cyclical stocks went up by 10x, and then the quality stocks just went up by 2x, right? So there is a huge outperformance in the short run. So whoever can play the cycles, really all the best of luck. But in the long run, you can't expect that just because I'm investing in the small and mid caps, you're going to beat the market.
So let's use the hurdle rate which you've used. Buy a company which has potential to grow at 20%, which means potentially profits can double in 3 to 3.5 years. If that is the case and a little bit of P expansion, the stock could easily more than double in 3 to 5 years. Where are you picking your spots where you think that in this kind of a market, you're reasonably confident of a 15 to 18% kind of an earnings growth?
So I think the pockets, again, where I'm finding ideas are, into the specialty chemical space. After a long time, they are getting cheaper with sort of the rupee going down, and there is obviously it went through a big correction, so valuations is in your favor. There is pharma space which is really looking good. Again, in this market, there has been correction. Gold finance looks pretty good. Home finance looks decently good. Luxury real estate, is looking good. And I continue to like, the building materials. Building materials, again, I think it's going to be a, really high growth time for a lot of niche building materials, like fabrication pies, electrical cables, conductors, a lot of even transformers. So whether the building materials are in the construction space or power space, I really like the power space. But again, it's all about which company are you going to pick, right? I mean, you have so many examples in when NBFC struggled, Bajaj Finance, Chola did exceedingly well. There are only two companies which really did really well across when that space did nothing. Even in the agrochemical space, PI Industries kind of a company did so well. So it's all about, I think, stock picking, betting on the promoters, making sure you understand the core competencies of that business, whether those are sustainable in nature. You can't bet on just low valuation or high margin, because a lot of times those are very temporary in nature. In good market, it's very deceiving. What is the it's very difficult to differentiate between good and bad, and you need such tough times to differentiate between good and bad. So I understand that a lot of investors who are going through this pain for the first time, it's excruciating. It's very difficult. It's stomach churning. But these are the times when you will really solidify yourself as a good investor. These are the only times which really teach you what investment is, and you will thank these times in the future. Otherwise, good markets make you a very, very weak, shallow investor. These kind of markets is what you need to increase your depth, and that depth is what will deliver you phenomenal returns going forward. So take this as an opportunity to learn, differentiate between businesses, and you'll thank yourself later on.
Okay, so I'll be specific here just for the benefit of our viewers. Power, and that is one sector where so many opinions are there. Power, power ancillary, thermal, non-thermal, renewable, tariff. What is the right way of looking at power?
Yeah, see, I think again, I am betting it through power finance, because then it's more, more diversified. Because whether it's renewable, whether it's nuclear, whether it's thermal, any kind of power infrastructure which is built, it can fund the distribution network, it can fund the power generators across the board. You will benefit. Whether if you just bet on a specific play, like whether it's a wind or solar, it completely depends on the regulations. So regulations are unpredictable. And if there are tariffs applied in the US and your export market takes a hit, the company can come crashing down. Whereas this is much more safer play, where the gross NPAs and the net NPAs will almost be zero. They are writing back a lot of provisions they had taken in the past. They're delivering 20% kind of a return on equity, as well as 20% kind of a growth overall, and you're getting these companies at 1.2, 1.3 times kind of a multiple, whereas at the peak in 2012 they were trading at 3.5 times. So reasonably valued. They may have corrected, but these are the opportunities. One has to differentiate between which are the long-term sustainable stories, because India cannot grow without power. So if you are betting on India, you need to find a risk reward plays within power, which will deliver you over the next 3 to 4 years.
Mention HFCs, home finance companies, you're betting on them. Now the big picture is great. Indian housing sector underpenetrated. The number of first home owners, that number I think is very low. But this is a brutally competitive space where spreads are not there, banks do not want to lend, and private companies are getting fueled because of PE funding. So while this is a great business to be in, is it a business where a lot of wealth could get created, looking at the constraints?
No, you're right. I think again, here you will only have one or two real winners, right? And the problem in this space was the valuations. If you look at, this valuation in this space, at least for good quality companies, where the, gross NPAs were controlled in 1 to 1.25 percentage, as well as the ROA. ROA is one of the most important factor, where high. So there are companies where ROAs are in the range of 5 to 7%, right? And their leverage is very low, 2 to 3 times, and hence the risk, is much lower. And especially when you can control the cross NPAs to, close to 1%, then you are. But a lot of these companies were trading at 7-8 times price to book, and same companies have continued to deliver 25% kind of a growth, and these are available at half the valuations of what they were available then. So for me, a good quality company where it's generating 20, at least ROA of 5 to 7%, where even if they leverage up to 3 to 4x, they can cross the 20% kind of an ROE hurdle and continue to grow at 25% plus. I believe that at least this 3 times kind of a valuation is pretty attractive. It won't go below. So at least, they have continued their growth, but the returns haven't been there mainly because the price to book got derated. Going forward, I think the price to book probably will only improve. Very unlikely that it will fall to 2.5 times kind of a price for a 20% ROE and 5 to 7% kind of ROA kind of a business, and hence you will at least make the returns which are equivalent to your earnings growth, which I believe should be in that 25% kind of a range. Again, here, I would not bet on the entire basket. There are companies who cannot manage the quality of the book, and hence one has to differentiate. I think that's the key. Again, picking the right company is the key.
Platform companies are high growth companies. 2-3 years ago when we spoke, you said, look, these are high growth companies, but they are loss making. Now they become very disciplined about what they want to do. Growth, I think, is there. Market share is there. A reasonable amount of visibility is also there. In this decline, is it a good time to start reloading platform companies, new tech companies?
Yeah, see, I think it also depends on your own expertise. For me, I don't have the expertise to differentiate which are going to be the winners over the long run. Again, these are the times when the entire anyone who is in quick commerce or anyone who is into platform, they have reason, right? But as what happened during the .com era, only one or two of these players will really become the winners. And it's an industry which has huge disruptions. It's an evolving industry. It's not stabilized. We don't even know what kind of profitability will they settle at. So some who are really experts in this, can maybe pick. Not for me. I would rather bet on old, boring, conventional businesses where I have little more capability of predicting their earnings margin, because they have gone through multiple cycles. And there are many companies today which are trading at 15-20 times kind of a if I 1 year forward kind of a multiple, where expectation of growth is in that 20-25% kind of a range. I'm happy with that, and I think this is much more high risk, high return game where the probability of failure in terms of percentage company failing is much higher, and definitely not for me.
Had specifically, I think this is a conversation we had in 2021 or 19, I don't remember, but we had a conversation that data is the biggest product now and everybody would be using data, and it has turned out to be true. We are consuming data after data, and the appetite to consume data is not dying. And that time, I think, just for the benefit of our viewers, you bet into a company which essentially is giving services to data companies, Sterlite. So in that theme, if you have to identify anything which is related with data, so from data now, the world is talking about data centers, right?
Yes.
Everybody is talking about efficiencies. So where else is the entire data theme moving? Because AI is also data at the end of the day.
Right. No, you're true. I mean, see, sometimes you get the themes wrong, but if you get the player wrong, and that was one of my mistakes, is that I got the player wrong, and so that's where picking the right player is important. So I mean, there's no question data center is something which will do really great. It's a theme for the future, but again, can I really bet on the right player is a big question, and hence it's very difficult to bet big money where if you are running a portfolio of 15-20 stocks, to bet on a data center play is very difficult. A lot of these beneficiaries probably would be global players, and very few opportunities are available in the Indian context. Sometimes the user of data, the user of AI may be the right place for you. One doesn't have to look at the infrastructure play in data or AI, but so for example, in AI, Amazon in US, or the penetration of connectivity and .com and internet, companies like Amazon took a big advantage of. So similarly, probably we need to look at companies who will be able to take advantage of that data, and some could be even the platform companies. When the entire India is connected, whoever can use the right now. I mean, see, we are on the lookout for some plays. I do believe that whichever is the most efficient data center play probably will become a big winner. We are evaluating, those options. We have taken some small bets on that. But again, it's in the long run, which are the companies who will survive, 5 6 years down, which are going to be the winners. And if you get it right, I think you can make a lot of money. But again, there are many opportunities right now, out of which only a couple of them will really become winners. And it is possible that you may end up getting on in the wrong play. So you need to be with an open minded, not just stick with one player. So, we had bet on Sterlite. We got it wrong, we got out. So again, in a small mid cap space, getting out is also extremely important. You can't get egoistic. You can't just believe that, I am the only one who is going to get it right. You need to be humble. If you get it wrong, get out, and then, bet on the right play. And that's what avoiding mistakes is not entirely possible. If you make a mistake, getting out is entirely possible. It's in your hand, and that's what one needs to do. If you bet on 20 plays, 2 3, you will definitely get it right, unless you are God. So when you get it wrong, you need to accept it, and even if you are in loss, get out and move on to the right play.
Point I just want to elaborate that for the benefit of our viewers, that right now, when you bought a mid-cap stock, and Samit, I'm making this point for the benefit of our viewers, which is that if you're losing 25-30% also, and if you think your template with which you bought has gone wrong, get out, please. Dil pe patthar rakh ke, you have to realize that emotions are not the best friend in a falling market. It is logic, and it is your understanding of the business which will always differentiate. You have to survive a lot of short terms to make money in the long term. And right now we are going through that survival in the short term, which is more important, so that when markets will normalize, you will be able to really make or create a lot of wealth in long term. So Amit, I'm just shifting some themes which you've associated yourself with in terms of an investment philosophy. And one of them you've invested over the years, ever since we've interacted, is specialty chemical. And at the outset, you briefly mentioned it. What is the right way to look at the big picture for specialty chemicals? There is one China plus play, there is a tariff at play, there is this dollar interplay. What should one look at if somebody is looking at specialty chemical, and why historically you've always been tilted to invest in that space?
Right. Before I get into the specialty chemical play, let me just add on to the point that you made, on the mid and small cap space. So see, one way, if you are lucky enough to have cash at this moment, of course, you can deploy cash when the markets fall. But most of the time, investors don't have, because your portfolio has also gone down. But this is a time when you should make sure that even if you're in loss making, try to build the right portfolio for the future. Forget about what mistakes you've done in the past. This is a time to sort of realign your portfolio for the future. When the entire market falls, extremely good quality companies will also fall, as much as sometimes, at least in the starting phase, as much as the poor quality companies. And once the earnings start differentiating, that's when they really outperform. But in the first phase of the fall, you will get a lot of good quality companies. So replace your poor quality companies with good quality companies. And many a times, in 2009, the fall was almost 75% in mid and small caps. In the next 14 months, they had recovered all the fall. That means the mid and small caps had gone up by 3 to 4x. That's the kind of jump you can get. Even during COVID, small caps had fallen by almost 45%, right? But within the next 5 to 6 months, they had recovered all the fall. So if you have the right portfolio, your recovery will be even better, better than that. So, don't get bogged down just because you don't have the cash. Utilize what's in your hand, and realign your portfolio for the bounce rather than just getting stuck that, I need to recover my losses from the same stocks. On the chemical space, see, Nikuj, what has happened is chemical space made a lot of profits post COVID, because there was a lot of chemicals go into the pharma space and there was shortage of medicines, there was a lot of inventory stock up. At the same time, China was going through shift, from urban area to the rural area. The government has forced these Chinese chemical plants to shift into rural area. So there was shortage of supply, increased demand, and because a lot of companies made profits, they all went for capex. So there was capacity expansion happening across the board in India, as well as when China shifted from urban to rural, they also put up multiple times of capacity. So now all of that is on stream and demand has normalized. So there is still a gap between supply and demand. So I would say if you want to bet on specialty chemicals, then it has to be really special where China is not a competitor generally in a bulk chemical, or where the quantum of volume is very high. That's where China is a big competitor. So one needs to be sure that this is a company which is one of the most efficient. So it can be in the CDMO space, it can be in the fluoropolymer space, but they should be able to compete against China. And anyways, across the board, all the customers do want to de-risk their supply chain because they have too much dependence on China. And with this geopolitical environment that we are going through, that de-risking definitely is going to happen. China plus one kind of a thing will surely play out. But unfortunately, the supply in many of these pockets is so high that there is margin pressure, and it's definitely not, we are not towards the end of that in many of the chemical play. One has to be very selective, understand the competitive environment, understand the capacity, how much there is, understand the demand side, because a lot of times it's not about the demand, it's all about the supply. If the supply is limited, and if there is even normal demand, the companies who are in that space will get reasonable margins. And there are some space, in the CDMO space, in the fluoropolymer kind of a space, where China, is not, because the volume there is not a big advantage. It's your capabilities and what capacity that you have. And plus India having the de-risking capability,
Right.
definitely is a favored destination for manufacturing.
Well, Samit, I've got lots of questions for you, but sometimes we say time constraints, and really look forward to a much more, engaging sessions with you going forward. Really appreciate your time.
Definitely. No, I really enjoyed this. Thank you so much.
All right, so that's an exclusive conversation with Samit Vartak talking about the sectors that are looking attractive right now, especially talking about the SMID space as well. But